Welcome to the DevReady podcast. Today we have Hamish Hughes joining us. Hamish is a long-time angel investor and has been advising companies for many years in terms of how to access funding and raise capital. Hamish, thanks for joining us.
No worries. Thanks for having me.
Now, the conversation today we want to talk about is obviously points of access of funding and how organisations may, or businesses may, or founders may have an idea or a concept that they're developing or about to, from a technical perspective. But then they're looking at, all right, what do I do now? How do I set my company up to be eligible to even talk to VCs, angel investors? What do I need to be in my pipeline or actually actioned from my perspective, as well as what are the options for me, and what is the pipeline of investments? So I just want to have that chat to you about that today.
It's
Sure.
probably, I would say, a bit before that is if they think they can just get investment because they've got a great idea. How do you sort of help them qualify that before they even, and then where can they go to look at everything?
So Hamish, before we get into that conversation, tell us a bit about who you are, what you're up to, and some of the help that you offer to businesses and ventures.
Yeah, sure. So I've been in and around the startup world for about 15 years now. I sort of fell backwards into it straight out of university. I literally almost by accident ended up with a job with the federal government overseeing a portfolio of what were effectively venture investments that the Howard government made.
Okay.
And so I was a wet behind the ears 23-year-old who suddenly got handed responsibility for about $20 million worth of taxpayers' investments into companies, and sort of said, "Oh, you look after these. We don't really know what we're doing."
Interesting.
So it was a real trial by fire. I definitely learned by failing. There's no question of that. So I did that for a couple of years. Saw where some of the opportunities and pitfalls and weaknesses of the overall sector were. I did that for a couple of years. I learned where sort of some of the strengths and weaknesses of the sector were, particularly in those days, in the post .com bust era, where really no one in Australia was interested in venture. I then went and worked overseas for a few years, came back in 2011 at the peak of the mining boom when no one in their right mind wanted to talk anything about tech. So of course, naturally, I set myself up to start investing into tech and advising tech companies. Was told by everyone that I was absolutely insane. And of course, then a couple of years later, started getting people calling me up, going, "Oh, so about this whole thing of investing in tech companies. Tell us about how to do that."
Tell us about that. Yeah. Okay.
Because somehow digging rocks out of the ground isn't looking quite as exciting anymore.
Interesting. Yeah. Okay. So, in terms of in terms of your initial starting point, working in that venture through the government, what were you looking at? Was it tech-based stuff, or was it other stuff as well?
It was a little bit of everything. I'd say at that era, it was probably about 30% pure tech, 50% biotech, and about 20% sort of miscellaneous other technologies. So a lot of industrial technology and manufacturing stuff and so on. I realized pretty quickly that I have absolutely no aptitude whatsoever for biotech. So I steer clear of that area because I really can't add any value, and if tech investing is like trying to find diamonds in the rough, then biotech investing is basically like trying to hit the Powerball multiple times in a row.
Interesting.
Trying to make the diamonds.
Yeah, exactly. So I generally steer clear.
Yeah, I get it. So, and you mentioned quite a bit of learning from that clearly. So was it more back in there, was that investment from a government sort of funding granting position, or how was that structured?
So at the time, the government had a program which was called, they had a couple of, one was called Commercial Ready, one was called Early Stage Commercialization. And they were basically helping companies that had gotten to sort of prototype phase or basic product phase and needed help to go from there to do the R&D. And so they were doing a matching program where if you said, if you could come up with a project and said, look, I need $3 million to do the next 12 months of business plan. If you could find $1.5 million in funding, the government would give you the rest. And then basically the government wouldn't take an equity stake, but would take sort of an oversight role And in the most important goal of the program was to keep IP in Australia for a longer period of time, because at that point what used to happen is anything that had a decent idea would just get sold overseas really early in the game.
Okay.
And therefore not generate value for Australia.
Value for Australia,
I mean,
get
the real proof in the pudding was that while I was there, and this doesn't have anything to do with me personally, but they did one of the big consulting firms did an analysis of the program and worked out that it was returning $7 for every dollar spent for the Australian economy, which, as far as I know, is still the record for any program ever done by the Australian government. Which of course meant that when the next government came in, they cancelled the program because it wasn't their idea and therefore shouldn't be used. But that's the nature of politics.
Yes. Goodness me. So, in terms of your role there, were you working directly with the organisations and businesses? Is that what your role was?
Yeah. So effectively, the way the government structured its money, it was you'd be approved for an amount of some money, let's say $1 million over 2 years or whatever whatever the length of the project was, and effectively that'd be handed out in quarterly installments. Okay. Based on budgets and progress and things like that. So really, what I was doing was acting as an oversight and working with the companies to say, okay, what have you done in the last 3 months? How's it going? Where's the project going? What do we need to amend? Very often, as is often the case with tech, the companies that come back and say, well, we started out doing this, and then we've worked out that we need to pivot, and so I'd work with them on within the limitations of what the government would allow. On their ability to pivot and amend the programs or the projects to make sure they were going in the right directions and so on.
Yeah, very interesting. So this was at 23. You were there for a couple of years, you mentioned, yeah? Is that right?
Yeah.
Very good. Thrown into the deep end and access.
Oh, for sure.
How many companies did you work with at that time?
I had about a dozen companies in the portfolio.
Yeah.
So it was between $15 and $20 million of government money.
Yeah.
So I think the biggest investment I was overseeing was about $4 million, and then there was everything down to sort of 250, 300K.
Okay.
Still nothing to sneeze at.
No, for sure.
Decent sized investments and
and particularly in those days, took nearly 15, 18 years ago. That was the idea of a company getting a $4 million investment round that wasn't publicly listed was just almost unheard of.
Yeah, exactly. So it's a great experience there. Then you went overseas for a bit. Was that in the similar vein, or is it a different area that you moved into?
I bounced around a bit, sort of broadened the horizons, as it were. So I worked in politics for a while, worked in management, did some management and strategy consulting. Went to graduate school, and then came back and sort of then re-examined the Australian market, having done some work in the UK in the VC industry there. And some projects over there, and saw how much more advanced they were, let alone obviously the Americans, and then came back and had a look here at how underdeveloped the Australian sector was, and so decided to get involved here.
So that was in 2011 you started here, correct? Yep. Okay. So let's talk a little bit more. So who do you generally work with? So it's tech companies. What sort of position are they in? Are they early stage? Have they been funded? Where do you come in the conversation?
It really depends. I often say to people the Australian ecosystem is small enough that you sort of have to be a generalist.
Okay.
It's not like America where you can sort of say I only do companies between X size and Y size and in Z sector and so on. More often than not. Because of the fact that I'm not operating, as part of a big, massive institutional fund or anything like that. I'm not dealing with late stage companies. So I'm not dealing with your companies that are saying, we need to go out and raise 50, 100, $200 million.
Okay.
So, I'd say I'm in terms of deal flow, in terms of stuff that's coming into my pipeline. It's anything from people calling me up and saying, look, can I buy you a cup of coffee because I've got a really cool idea for a business, through to, hey, I've been operating for 2-3 years, this is where we're at, this is the product we've got, this is the early stage progress, we need to raise capital to take it to the next level. Can you help us?
Okay, so it's a variety there.
Yeah, and so in terms of if you want to quantify it in dollar terms, it's anything from the company saying we need our first, 2 to 500,000 of sort of really sort of seed funding, through to companies saying we want to raise, 5, maybe 8 to 10 million in sort of A or late A kind of raise.
So there's a wide gamut there.
Yeah, and ultimately that's the one of the reasons I do operate in that space is that is the hardest space in which for companies to raise money in Australia. It's relatively easy. Most people or many people can raise that first sort of 100, 200 grand. Your friends and family rounds and all of that. Once you're really established, then there's plenty of avenues to go and get your institutional funding, but in between is the valley of death.
Valley of death, yeah, getting through that is not that easy. So you raise your first 100, 200 grand, and then what do I do now?
Exactly right.
That? So not generating any revenue. What do I do after that? So
exactly right. Yeah.
In terms of exploring this journey, should we start at the fact of let's begin? I've got an idea. Let's have that chat with Hamish. What do I need? What do I need to get to my first $200,000 raise? And then we'll go through the journey of now I'm at my $200,000 raise. Spent that money. What do I do next? I think we'll go through that conversation more as a structured approach, taking people on that journey, what it looks like.
Yeah, sure.
So I'm starting out. I come to Hamish. Hamish, I've got this brilliant idea, tech space. Maybe I'm a domain expert in a particular area, and I'm trying to solve a problem that I see could add some value to some significant people. What should I be doing to maybe document this idea, start prepping to get my first round?
Okay, so the first thing that you're going to want to spend some time putting together, and this really applies to all businesses that are trying to raise money, is a pitch deck.
Okay.
So first of all, don't make the mistake that some companies do of going and putting together a 50-page written business plan, 50 or more. I mean, 50 is on the light side of some of the ones that I've seen.
What? Okay.
Don't bother with that.
Why do you say that?
There's two reasons. One is as an investor. I mean, if you want to use it for your own internal discipline purposes, that's one thing. But as an investor, first of all, I'm not going to read it because I don't have time to read, a 50-page document for every company that is pitching me. Secondly, if you're super early stage, 90% of what's in there is guesswork.
True.
And
nothing's
so,
been validated.
So putting, for me to read guesses that are based on guesses on guesses on guesses, it's fantasy. It's like when I see early stage companies that start showing me 5 and 7 year financial projections.
Yes.
Anything beyond 12 months, you're guessing. Anything beyond 3 years is a pure work of fiction.
Yep.
And even 3 years, for early stage, it's you're literally hypothesizing on top of hypothesis. So it's largely pointless.
Yeah, I agree with that.
So for super early stage, I generally say to people the slide deck should be no more than sort of a maximum of 15 slides, preferably less.
Okay.
And effectively, you're walking and you're saying, what is the problem? How big is the problem? In other words, as an investor, why do you care? Because you could be solving a problem that 3 people have, at which point it's great, but it's not investable.
Get it.
Yep.
What is my solution? How am I different to anything else that's already out there?
Yeah.
How will I actually make money for you as the investors out of this?
Okay.
And then, who am I? What is the team? And then finally, what is the ask? How much do I need? How much am I asking you for? What am I giving you in return? Etc.
Okay.
That's a really sort of back of the envelope layout, but that's more or less what you need to cover.
So do you need to sort of indicate what you're going to use that money for in that pitch deck as well?
To a degree. When you're doing super early stage and you're not raising huge amounts of money, by all means you can put a use of funds in, but don't get super granular. No one cares whether you're spending $45 on a printer cartridge or $48. It's more, hey, I'm raising 200 grand. 50 grand is going into dev work, 50 grand is going into marketing, etc., etc. It's more to give a sense that you've had to think about it,
Yep.
more than anything else. And the dirty little secret, particularly with very early stage investing, is for the most part, as an investor, what you're doing is you're betting on the team, you're betting on the people.
So the people and team are your focus.
Yeah. I'm a big believer, and I've learned this through painful trial and error, that an A grade team with a B grade product
Yep.
will absolutely obliterate the opposite every time.
I like it.
So, and the result of which is I've developed a few sort of sets of sort of broad general rules for myself, for my own investing, around teams,
Okay.
and founders and so on, and sort of more sort of red flags of things that I won't invest in. The number one of those being solo founders.
Won't invest in solos.
I won't invest in solo founders. I've been burnt too many times doing it.
Okay.
Okay.
And I've worked out over the years that there's sort of two reasons for that. One is that obviously if you have a solo founder, it's a critical point of failure.
Yes.
So I had a company that I led quite a large investment syndicate into, sort of several $1 million.
Okay.
And it turned out that the founder was bipolar.
Ah.
And
Okay.
and undiagnosed and untreated.
Yes.
And what he ended up doing was blowing up the company because he was lying to his own board. So he was making claims about customers and contracts and things that turned out to be fanciful, and so the company ended up going to the wall because the board was he was providing financial reports to the board that weren't real.
Ah, actually lying about financial reports.
Yeah.
Okay.
Right. And it wasn't he wasn't malicious. He was just
Yes.
he was unwell.
Yeah, get it. Okay.
And so things like that can happen. The other reason for that I don't like to invest in solo founders is, to me, I'm of the view that it's pretty much impossible to build a company of any size by yourself, and therefore a big part of successfully building a company is your ability to attract talent, attract and retain. And the first step of that is being able to find co-founders, as far as I'm concerned.
So would it be an advisory board or something like that, or is it more co-founders in the core team?
People who want to work with you.
Okay.
Yeah.
Who want to be on this mission, solve this problem, and add the value.
Yeah. Because advisory boards are great, but at the end of the day, most people who are on advisory boards, they're busy, they're doing their own thing, and maybe they're talking to you once a month or twice a month, but they're not in the guts of the business.
Yes.
Yeah, they're just there as a sounding board every now and then.
Exactly.
And I think we've had a conversation around advisory boards and how to build one. I'd like to learn more about, if I am a solo founder, what should I be doing? Should I be looking to fill in the gaps that I'm not aware of within this marketplace? Where would I start? So I might not be. So we're talking to non-techs really building tech and have a problem that they need to solve with technology. Would you recommend them looking for a technical co-founder? Maybe someone?
Yeah, ideally. I mean,
What would you
obviously, it
recommend?
depends a little bit on the business or the product that you're looking to build, but ideally, yes, a balance of skills. So
Balance of skills,
if you have a founding team and it's 5 techies, and you're building a B2C product,
That's a problem.
that's going to be a problem, right?
It is, yeah. How do I
Or
solve
vice
this?
versa. If you've got a founding team that's 5 guys from the advertising industry, and they're saying we're going to build this software platform that supplies our industry,
Yes.
I'm going to go, cool, who's going to build it?
Okay.
And just entirely outsourcing it, the build. I'm a big believer that you can outsource the initial stages of tech building.
Okay.
So and I know that's part of the model that you guys work with, and I think that's
early
quite good.
stage sort of prototyping.
Yeah, and I
getting it to
think that
first
is
fit
very
the thing.
functional. But I think at a certain point of the company growth, you have to be able to bring things in house.
Yeah, you need to control the direction of the product.
Yeah,
have your own
and
resources.
ultimately you also need to have people on the inside who are fluent enough, even if they can't build it themselves, they can understand how it's built.
Understand.
Yep.
And I see a lot of what I refer to as the the midlife crisis entrepreneur, which is the 40-something, bank executive / industry exec, sort of mid to senior
Midlife
management.
crisis, I like it.
Yeah, mid to senior management, who,
Yeah.
who call me up and say, I've been in the insurance industry for 25 years and there's this massive gap in the market, and I've got the killer idea to solve it, and it's going to be $100 million business. Can we get a coffee? I said, yep, sure.
Yep.
And we go in and we talk about it, and it's a really cool idea, and we get to, okay, well, what's your who's your team? Oh no, it's just me, and I'm going to hire a tech company to do the build. All right, cool. So how much money do you need to get off the ground? And it's almost always the same story.
Yes.
It's I need $500,000.
Okay.
Okay, cool. What do you need the $500,000 for? Well, I need $250,000 to pay the development company to build the prototype for me. All right, fair enough. What's the other $250 for? Oh, the other $250 is my salary for the first year.
Yeah,
Oh, no.
so they're just covering themselves.
because that's what I'm earning at the moment at the insurance company, and I've got 3 kids in private school and a mortgage and car payments, and that's what I need to live on.
And what do you say to that?
My response is always the same, which is fantastic. So I'm going to own 95% of the business, and you're going to be an employee. And they always go, "Oh no! I thought I'd give up 5 to 10% equity for that."
Nice. So they're looking to...
And
So they want to get paid.
and I go,
at the same
so
time.
exactly where is the risk that you're carrying? Oh well, I'm leaving my job, but you're not. You're being paid by me. So I'm now paying your salary. I'm now carrying you on my books.
Yes.
To give you the chance for the privilege of giving you the chance to build your own company.
And just provide the idea and not actually do anything in it.
Exactly.
Yes.
Exactly. And
Interesting way to think
ideas
about
are great,
it.
but execution is where it's at.
Yeah, get it. Okay. Yeah, I think people appreciate that. I think everyone sort of doesn't realise that if you're going to jump into a startup or a venture, be prepared to not get any income for a number of years potentially.
Yeah. And
you
look,
are
I'm not someone. Let me be clear. I'm not
Yeah.
one of those investors that you see on the Shark Tanks of the world that sit there going, "Oh my God, how dare you take 30 grand out of the company?
Yes.
What's wrong with you?" Like, people need to live. People need to
Yes.
eat. But it has to be reasonable. And if you're going to have all the upside of the equity, then you're going to have the sweat risk of
Yes.
not taking money up front.
Okay. And I think people need to hear that. So yeah, it's a good share there. So this founder that you basically drill this into and just say this is what the reality is. Next step is build team, or are they okay to go and outsource that first build? Are you okay with that model or not really?
It sort of depends on. It depends on the product. Like everything's a little bit different, but
Yes.
it depends on also on what they're asking for. So if they want to go away and through whatever external source or internal source, if it's their own money, go and get a prototype built,
Yes.
and then come back and say, look, here's the prototype, here's the first version, the MVP, the first customers, the pipeline, whatever. That's a bit of track record.
Yes.
And then you can start having a conversation about, okay, can we help you build out the team? Do you need a team already, etc. That's a bit of a different conversation. But
Okay.
when it's I've got a really good idea, I haven't done anything yet, I'm by myself. To me, it's just way too risky.
Too risky. Okay.
Like
That makes sense.
even at the later stage, if they come back by themselves, at this stage in my career, I would say a condition of investment is that we build out your team.
Okay.
I wouldn't let them. I wouldn't give them money and allow them to remain as a solo person.
Okay.
And in building out their team, would you recommend they get everyone on board, or is it they can get a team on board, and if they put equity into it as well, so sweat equity for a lower rate?
I don't really have a strong view, one way or the other. I think, I like the idea of people being incentivized to grow with the company. So I am a believer in sharing the equity around. I don't like companies where you end up with a situation where the founder has 90% and then there's 3 devs that have 2% each.
Yep.
Because at that point, those devs aren't really that motivated to stay.
There's not much upside, right? Unless
Yeah,
we
exactly.
sell out for $500 million or $1 billion. So
We get those offers all the time from people. I started to call them the startup specials when they approach us.
Yeah.
We get an idea and they're like, "Oh, we'll give you 10%, you work for free, and just keep in mind this is going to be like a $500 million company in 2 years."
Yeah.
Yeah, no worries. I've done the calculations too. I've got monopoly money at home.
Yeah, and that's the thing is that the reality is that, and I've lost count of how many times I had to say this to founders. 90% of companies will fail. That's
Yes.
just the math. You're not a special and precious snowflake. You're part of that 90%. Odds are, even if you do everything right, your company will fail. I had one of the stories I love to tell is I was a seed investor in a American business who was a mate of mine from university. Absolutely brilliant piece of technical software. He was next generation database technology, and he was kicking goals right, left, and center. The technology was amazing. He had the early clients, early revenue. He raised a couple of $1 million. He then got a term sheet signed with one of the big New York funds for sort of what at the time was a big A round. What these days it'd be a small A round.
Okay.
But I think it was about $6 or $7 million. And he was flying to New York to finalize the paperwork and pick up the check.
Yeah.
And while he was in the air, Bear Stearns collapsed.
Oh.
And so he lands in New York in 2008, September 2008.
Great timing.
Shows up at the fund's door, says, "Hi, I'm here for my meeting to pick up my check so I can help build my business." And the secretary turns around and says, "Yeah, so all the meetings are cancelled. The fund is gone. We're freezing all new investments for the foreseeable, etc., etc." Long story short, his business ended up going to the wall and going under through absolutely no fault of his own. He did absolutely everything right, and he just ran into the buzzsaw of market timing. And I've seen so many companies. I mean, that's obviously an extreme example, but I've seen so many companies that's happened to.
But it's good to give that example because he's got clients, his early stage revenue is actually there, about to get a $6 to $7 million investment, and then it goes belly up.
Yeah.
So that 90% being in that is not that easy to get into that 10%, is it?
Yeah.
And it's not out of your own. It's out of your own hands. It's not out of your own fault.
Exactly.
Yes.
I mean, I actually had a conversation last week with another friend of mine who's another American startup, one that I'm not personally invested in. But he called me up saying, "Look, we were 3/4 of the way through our B round.
Yes.
10 million US. We had 8.5 million committed, and then COVID hit, and our keystone investor, who was in for $3 million, has just pulled out.
It's pulled out. Great.
So can you help, sort of thing.
Yeah.
So again, this guy's it's a shipping technology for the shipping industry.
Yes.
Again, nothing he could have done. There's nothing he can do to avoid, global pandemics.
Interesting stuff around timing. So let's dig a bit back into this. So we've got in terms of your first pitch deck. So on that 50-page pitch deck, talk about the problem. What is my solution? How big is the market? How am I different to everybody else that's out there? What money do I need? Who's my team? Which you see is you weight that pretty heavily based on this conversation in terms of who your team is. So what am I asking for? Once I get my pitch deck done, where do I go and who do I reach out to actually start having conversations of investment? Everyone says talk to your friends and family first. What are the options for me?
So there's a few, and I'll just jump back for 1 second into the pitch deck. Just one more point.
Sure.
When and this is just a personal pet peeve, but when you talk about the market size, young entrepreneurs out there or early stage entrepreneurs out there, do not under any circumstances make the following error. Do not say the market size is $100 billion a year, and if I can just get 1% of that, my business will be super successful. That to me is almost an automatic pass as an investor. Because that to me tells me that no one's done the homework as to how you're going to get market share. So that's just an aside.
Okay.
In terms of who you talk to,
Yes.
There's obviously angel groups. So you've got some local ones here in Australia. You've got your Sydney Angels, your Melbourne Angels. You've got some industry specific angel groups. So an example of one is Energy Lab,
Okay.
which focuses specifically on companies around the renewables sector. There's incubators, so some of which are more generalized, like your butter factory,
Yes.
and
Yep.
and some of which are more specialized. In fact, there's one group called Slingshot, who have an interesting model where they partner with a large corporate partner on each cohort, and so each cohort is themed to that corporate partner. So they might do a deal with Coles to sponsor one cohort, and so all the companies coming in will be around the food tech industry.
Yeah. That's an interesting model
Okay.
where they get a good look under the hood of some startup ideas.
Yeah,
Okay.
and so what those guys end up doing is they give you a small amount of money, and then if you can go and raise more funds outside of that, they will then do matching funding with you. So that
Okay.
they'll participate in further rounds. There's obviously university incubators,
Yes.
which have a mixed track record of success, but they're a good place to do some learning. And then there's the more sort of prosaic things, which is jump on LinkedIn and start searching people out. I get a hell of a lot of cold calls
On
or
LinkedIn.
effectively cold calls on LinkedIn.
Yep. Okay.
I probably get 5 or 6 a day.
Oh, wow.
Of people just reaching out saying, "Hey, can I connect? I've got an idea." And my answer generally, and most professional investors, the answer will be, "Sure, send me a deck, and then I'll
Okay.
let you know if I want to have a conversation."
That's better than the messages I get on LinkedIn.
It's one thing that I would say is if someone does ask you for a deck, don't get cute about saying, "I don't know, but I want to pitch you first."
Okay.
That's
so
not the
hand
way
the
it
deck
works.
over.
You hand the deck over and effectively you're saying, I'm trying to get you interested enough, even if it's a teaser deck, even if it's a 2-pager,
Okay.
even if you don't want to do a full deck, just something that lets me know, is this worth me spending half an hour of my time talking to you?
Okay.
Because at the end of the day, there's an awful lot of companies reaching out, and
Yes.
at some point you have to sort of do a triage.
You get to understand that.
The other thing that I would say for super early stage is forget NDAs.
Forget NDAs.
Yeah.
Yes, I've heard this
Okay.
many a time. So explain.
Yeah, NDAs, non-disclosure agreements. You get a lot of less sophisticated entrepreneurs who hear about NDAs, think they're a great idea, and start going, "I've got this amazing idea for a company. If you sign an NDA, I'll tell you what it is."
Yeah. Okay.
Yep.
Any investor with half an ounce of experience is going to say, "Thanks very much. Have a good life."
Okay.
Because first of all, in large part, the NDAs aren't that enforceable. But even where they are, the problem is, I as an investor, I'm seeing, 30, 40 pitches a month.
Yes. And I'm sure across similar
And
sectors.
that's
and
exactly
ideas.
it. There's an enormous amount of cross-pollination.
Of course.
And so the idea, I'm not going to open myself up to the potential for litigation of, somebody sends me an NDA about a cleaning technology,
Yes.
and then 3 months later I go and invest in something else that's another cleaning technology, and then they come back and say, "Oh, well, you stole my idea."
Yeah.
It's
okay.
just not worth
Yeah.
it. It's a little bit like the fact that in Hollywood, you can't send a script to a studio unsolicited. They'll just throw it straight in the bin.
Yeah.
It's sort of the same model.
Okay, get it. Yeah, it's. I think it's people think they're protected in some way, but in reality, if someone's talking to an investor, they're not interested in actioning. They want to invest in people that they believe the team can deliver an idea. If the idea is great, they will want to work with you. I think people are just frightened that people are going to steal their ideas, but in the end, it's all about the execution. An idea, like I said,
Yeah.
is really worth not much.
Yeah, well,
Team
I'd say there's
execution.
two things. I agree 100% with what you're saying. And there's two things. One, exactly to your point, that
Yeah.
idea and execution are two very different things.
Correct.
And I've seen 50 different pitches that are on basically the same idea. The company that is successful is the company that can actually execute on that. Not,
Of course.
Yeah.
so just having the idea is great, but that doesn't really get you anywhere. The second, and this is sort of the soft protection, if you like, for entrepreneurs,
Yes.
is that this is a small industry. and reputations are painstakingly built and easily destroyed for investors.
Okay. It's a fair point.
And so if an investor gets a reputation, which is very easy to get, of being someone who is a bit shady and rips people off and so on, all you have to do is you can be an ethical person for 20 years. You do that once or twice, and the 20 years don't matter. And then all of a sudden, no one wants to deal with you. So there is and I think that's a good thing. But I think that does provide a good amount of protection for entrepreneurs. That it's not worth it to most serious investors to try to rip off an idea, because it's going to end up biting them on the back end.
Yeah, it's also probably not. You're not going to have the same passion as that person who's got the idea to try and make it work.
Oh, for sure.
As well, so there's
or the right expertise, quite frankly.
Yeah, so that limitation of them saying, I'm not going to tell you anything because I'm scared you're going to do it, it's not thought through properly.
It's just
I don't know how many of these things we've had to sign for people just so they can talk to us sometimes.
In our early days we would do
too many
that.
people have watched The Social Network and think that's the way that it actually works,
And we're not going to go and take anyone's idea and build it ourselves.
Yeah.
We
And
don't have
I
enough
can tell
time
you,
to-
I've met the Winklevoss twins, and they were never going to build Facebook.
Well, there you go.
Yeah, we don't have enough time to build our own ideas, let alone try and
Yes.
take someone else's idea that we don't have any knowledge about in their space.
You got to think about it. We've got our ideas sitting there to build our own tech.
Yeah.
They trickle along, and 12 months down the track, we've done a bit of it. But the reality is we're all busy doing our own thing.
Exactly.
Think about that. Yep. Very, very cool. So pitch deck is number one. Team is highly weighted within that area. Obviously, the idea has to make some sort of sense, as well as the market share. You have to be really clear on what you're going to capture within that market. So some really good tips there. And obviously, you're going to need some market research. You can't just put a pitch deck together in an afternoon off the back of an idea, I would imagine.
Yeah, and again, with things around market sizing, the more you can show your thought process, the better.
Yep.
It's a little bit like when with the big strategy firms, your Boston Consultings and your McKinseys and so on, they're well known for when they have job interviews of doing what's called a case study, where they sit you down as you do the normal job interview, and then they sort of turn around and say, all right, can you tell me how many petrol stations there are in America? And obviously they're not actually wanting you to be able to tell them how many petrol stations are. What they want you to do is sit there and sort of talk through how you might work that out. And what your thinking is to try to make an estimate. And they're looking at the thought process. It's a little bit the same with investors, that if you come in and you say, I'm building a cosmetics brand, and it's this very specific twist on it, and it's to appeal to this subset of the market, and so on. And then the next slide is the cosmetics industry is a $50 billion a year industry. I'm going to go, well, that's your thinking isn't logical there. You've already told me that your niche is this little slice of it. So go and work out how big that slice is.
That niche is,
because telling me, I make potato chips, and the size of the global supermarket industry is X, doesn't tell me anything about what the market for potato chips is.
No, get it. Yep. I think that's common sense there. But sometimes we can look at and get carried away in numbers, and I think as soon as you do number crunching as a venture and a startup, how big this market is, and that 1%, 10% of it.
Yeah, well, and I think people fall into the trap of worrying that I have to show the biggest possible number.
Yes.
And look, you it's true, you have to show a big enough number that it's interesting for the investors to get involved, but you also have to show them, if it is something that is super niche that you can get a big chunk of, that can also be just as interesting as something where you're getting a tiny sliver of a bigger pie.
Yeah, get it. And sometimes it's easier to get a bigger chunk of a smaller market than it is to get a big market and get a smaller chunk of it, because your niching is a bit easier to actually tune and attract the right customer. That's what I've found in our ventures. So we've got a venture in pharmacy, and we found that putting it there. It could be in retail too, but we haven't chosen to go on there because retail is just another world. And just focusing in on a niche opens up a lot more doors than you think.
Yeah, as long as the niche is big enough.
Yeah, correct.
You know, I mean, I got pitched a business recently, which was a facial rec business for the pharmacy industry, for a particular use in the pharmacy industry.
Yes.
Which was great, except then when you know, I sort of talked him through his actual market size, and we worked out that his actual market size, if he got every single pharmacy in Australia, was about $1.5 million a year.
Okay.
And I said, well, you know, that can be a really great business for you, and you can do really well out of that. It's not investable. And I suppose the with that market size, it goes to a bigger point that I think a lot of entrepreneurs don't necessarily understand, and not through no fault of their own. It's just no one's sort of explained it. Early stage investors, because of the fact that the failure rate for early stage investments is so astronomically high,
Yes.
the return that early stage investors have to look for has to be correspondingly high.
Understand. Yeah, risk reward.
Yeah.
So if it's like one out of every 10 fail, you need a very big return to cover the other 9 that have failed.
Exactly. So that, you know, the rule of thumb is that if you're doing early stage, so sort of that seed angel level, you've got to be looking at you've got to be able to be convinced that your investment has a 10x potential for return within 3 to 5 years.
Okay.
So, you know, I see a lot of very solid companies that, you know, I would have no objection being part of, who come in and say, you know, this is what we're doing, this is what we can tap, this is what we can build, and, you know, we reckon we're worth, you know, $3 million today, and in 3 years' time, we reckon we're going to be making $500,000 a year. And I go, that's fantastic, well done. You know, you've built a good little business. You're gonna, you know, be quite prosperous off that. As an investor, the business isn't going to be worth 30 to 50 million. Therefore, it's not for me.
Yep.
Just because it's not big enough.
And is it difficult, like with the smaller opportunities that come across, to get to that level? Or is there another sort of investor that would be happy to get into that?
There are other investors that'll be happy to get into that. They'll generally want different aspects, or their structure of investment will be different. So often they'll do debt. Sometimes they'll say, I want to buy in as a partner. They'll generally want a bigger chunk of the business.
Yep.
But it's and often they'll, you know, often for those you want to go and find someone who can really add value and be a genuine partner in the business, as opposed to, you know, just an investor and a advisor sort of thing.
Yes, it's someone that takes responsibility in the business, not just checks up on you and then waits for a sale.
Yeah, exactly.
Yeah. Okay.
And the other thing I would say, just overall, with all early stage investors, or sorry, on behalf of the entrepreneur, is if it is at all in your power, so if you have any selectability at all with your investors, try to pick investors, A, who you get along with, and B, who you think can add some value to your business beyond just writing you a check today.
Yep, so sort of you're vetting the investor as they're vetting you.
Exactly, because ultimately you're going into some degree of partnership with them, and, you know, if they're the type of person that's giving you the vibe that they're going to be calling you up every 3 days saying, you know, why have you... why is the company logo blue instead of grey? Then, you know, do you really want to take their money?
Yeah, so that's sort of like the little image you see that on like Shark Tank. The people in different industries with different expertise, and then the investor will have to pick, if they get a couple options, of which one they think is going to be the best fit and bring the most value to the business.
Yeah, and I suppose what I'm saying is the entrepreneur should try and do the same. If they can. I mean, if you're in the position of, I desperately need money, there's only one person writing me a check, then so be it. But if you have any ability to discriminate, you know, do your homework on the investors as much as the investors are doing their homework on you.
Yeah, and so would you say that from an investor as an investor, someone looking for an investor, that you should be trying to find someone that can bring in more value, or just the money? Like if you get a couple offers, it's obviously going to be trying to see what the total value of their offer is.
Yeah, ideally, and the value doesn't necessarily have to be tangible. So it's not necessarily they can write me a bigger check. One of the things to think about is are they the type of person that can help me raise the next lot of money, whether that's through themselves or through their networks.
Yeah, that's a great
do
point.
they have industry expertise they can help me with? Do they have contacts they can help me with? And what is their appetite to be involved as well?
Yeah.
Because you have some angel investors who just want to write you a check and call me in send me a thing every 6 months telling me how you're going. You have other ones, and I count myself among these. I'm fairly activist, not in a I'm going to come in and tell you how to run your business sort of way, but in a hey, I'm at the end of the phone line. Call me up with anything you need, any advice you want, any connections I can make for you, because ultimately it's in my interest for you to succeed once I've written you a check. So if I can help and just be a sounding board on a regular basis, then by all means.
It's strange that some investors don't sort of share that personality. Just looking from my perspective, it's if you're putting money into something, you want that to succeed as much as possible, not just play the averages game. So why wouldn't you put in as much as you can?
Most of the angels you're dealing with, if they're not institutional, they're only making, a half, maybe 2 or 3 investments a year, if that many, and so they should be doing more homework as to what they're investing in.
Yeah, so if you're dropping out the 25, great. How many investments would Artesian be doing annually, or in a fund series?
Across the fund, over 100.
Yeah, okay, it's very different. Yeah, very different model. Okay, so let's paint a picture that I have received some early stage funding, some seed. Maybe I built a prototype. I've got some interest from customers. Potentially, I've got a little bit of revenue coming in. What's my next stage from an investment perspective? What are my next options to scale this out?
So you've done sort of that first round of funding. Let's say for the sake of argument that you're looking to get into that sort of anywhere between 500,000 and 2 mil.
Yes.
To go to the next stage. So there's a few options.
Okay.
One, the most obvious is going back to your initial investors and saying, hey, this is what we need to do to go to the next level. Who wants to participate? What's your capacity to?
Okay.
And none of these, by the way, are mutually exclusive. Like these may all attach to one another. But yeah.
Understand.
So that's the first. Then obviously you've got external money. So that can be finding more early stage investors. That can be going to your venture funds.
Yes.
Who and finding the right venture funds who fit what you need and what you're doing, and then going and pitching them. There's the family offices, which are a big part of that early stage scene, particularly in Melbourne.
Okay.
More in Sydney as well, but especially in Melbourne. And that's a little bit of in some ways a little bit of a secret society of you have to get in there and it's who you know and so on. But if you can get in there, that's often a good source of funds and growth.
Okay, interesting. So the family, their family investment house,
exactly.
Basically. Yeah,
exactly.
So high net worth, basically.
High and ultra high net worth. You're talking. Some of the bigger ones would be your Baileys, your Weislitzes, groups like that, Thorny Group, who are, your super high net worth people who are worth families that are worth in the hundreds of millions into the billions,
yes,
and who have investment arms.
Okay.
So you go in and you pitch them much in the same way that you'd pitch a venture fund. It's just that their money is all coming from one pot as opposed to a series of
multiple
institutional
sources.
investors.
Understand.
There's obviously, if you happen to be in the right industry and setup, there's obviously bank financing,
yes,
but that's usually fairly tricky.
Challenging.
And then there's the one that definitely has its pluses and minuses, but is something that a lot of people don't know about, which is the public markets.
Public markets.
Yeah, so
Okay.
IPOing basically.
Yeah, that's a whole different thing. So maybe we'll explore that a little bit.
Yeah, sure.
IPOing.
So, and that's something I've been involved with a few companies that have gone down that road,
Okay.
where Australia's unique Australian markets are unique in that the cost of listing and the cost of compliance is quite low.
Okay.
And you have an Australian investment industry that on the one hand is fairly suspicious and reticent when it comes to private companies, and on the other hand quite open to experimentation when it comes to public companies. And I think that probably is a relic of the mining exploration industry, where you've got all these companies that are listed on the ASX that are searching for gold or diamonds or iron ore or whatever, and basically they're listing on the back of I own a piece of land and I'm going to drill some holes in it. Can I have $10 million, please? And every 3 months I need another $10 million to drill some more holes.
Yes.
And eventually, hopefully, I'll find something in one of those holes. That's pretty much the mining exploration model. As a result, there has been an ability for early stage tech businesses to list. It's getting slightly harder now, but it's still definitely an option. And I've seen companies. I mean, we had one business that we were involved with that went from its first dollar seed funding into a listing in 11 months.
Oh wow, that's huge. That's very quick.
So they were able to raise about $8 million in an IPO
in 11 months.
11 months in.
Oh, wow.
And then they've been able to raise subsequent rounds of capital. So I think all up they've raised probably about $17 or $18 million since listing, to help grow the business.
Okay, what type of business is that?
It's an esports business.
Okay, good. Nice. Yep. Is that Mogul by any chance?
Yes, it is.
It is, yes.
It is indeed, yeah.
So I've had a couple of podcasts with guys, Jamie Skeller and Adam as well, actually. Yeah, just chatting a little bit about that. So interesting.
So I had I was a seed investor in that business. So that did very well for everyone.
Yeah, I can imagine.
All
Given that's one of the that's a tick in the current situation for yourself, I would imagine.
Yep.
How many investments would you do annually? Where do you sit? Are you more that 2 or 3 potentially?
I'm probably a bit more active than that. So I'd say it's probably around 5.
Okay.
But not much more beyond that. And a large part of that is because I'm a big believer in active participation.
Yes.
There's only so much bandwidth I have to help and add value, and so I don't want to invest in a whole bunch of things and then not have time to be there as a supporter.
Yeah, I understand that.
Yeah.
So let's just talk for a couple of minutes on that IPO component. Now, IPOing obviously has regulations, everything about that. How do you generally advise someone that wants to explore that? Are they looking at backing off the back of another company that's already listed? How do you generally do that?
So it used to be that exactly to what you said. It used to be you had a lot of companies doing what were known as reverse takeovers.
Yes.
Otherwise known as backdoor listings, which was taking an existing, often largely defunct listed shell, so like a dead mining company or something like that, and
generally dead mining company. Yep.
The ASX has largely closed that avenue.
Okay.
In the last couple of years, because you were getting so many companies pushing through there.
Yes.
So now, pretty much what you're looking at is a vanilla, straight front door IPO.
Okay.
There are definitely costs involved in doing that.
Of course.
So the cost, give or take, the cost of running an IPO process is about $500,000.
Okay. Yep.
But often what companies do, if they are going down that road, is they'll go and raise a pre-IPO round specifically to fund that process.
So raise the $500,000.
Yeah, so they might go and raise $1 million pre-IPO.
Yes.
Pardon me. And say, look, $500,000 of that is for our operating costs over the next 6 to 9 months, and $500,000 is to pay for the IPO.
Yes.
There are, when you're looking at the pre-IPO into IPO route, you open up a lot more avenues for investment in terms of who you can talk to.
Okay.
All of a sudden, the stockbrokers want to talk to you. A lot of the institutional funds want to talk to you because most of them are actually barred from dealing with anything private.
Okay. So
but as soon as it's public or quasi-public, which is a pre-IPO, then they can get involved.
Interesting.
So, as an investor yourself, would you see that as more appealing than a normal private investment? like getting them the pre-funding for an IPO and then getting them to an IPO?
I mean, it obviously depends on the business, but there are definitely upsides in that you're talking a liquidity event. So you know, if I can put money in into a pre-IPO, and the rule of thumb with pre-IPOs is it's done at a 20% discount to the IPO.
Yes.
And it's usually sort of 6 months odd before the IPO. So then you're looking at, okay, I've pretty much locked in a 20% return on my money in 6 months.
In 6 months, so 40% annual return.
Yeah, plus you know, whatever the upside of the IPO actually is, if it's a hot IPO. You know, so if the IPO is at, I mean, you know, Mogul is an example where you know, we did a pre-IPO round, we did the IPO, and then it doubled day one.
Oh, wow.
So effectively, and the pre-IPO round was done at a cent. So and it went to nearly 4 cents on day one. So you know, effectively the seed investors made 4x in 6 months.
Okay.
Yep.
So that's a perfect
very
world.
lucrative if you get into the right.
That's a
one,
perfect
of course.
world, obviously, but but you know,
Yep.
and there are restrictions. The investors can't, you know, dump out all their shares and things like that. There are some protections in place, but you definitely engage a different group of investors when you're talking on that front.
Now, what type of business would be accessible to that market, to an IPO? How big would the market have to be? What are some of the tick boxes that I need to consider from starting out? And this is something that the channel I want to explore.
Yeah.
What are some of the key things I need to consider there?
I think that I think my guess anyway, and this is just a guess, is that the days of being able to list something that is completely pre-revenue are probably over for a while.
Okay.
Just because of where the market is right now.
Yes.
And there has been a pullback, largely driven from the US with the failures of your WeWorks and things like that, where people have suddenly started to go, well, maybe growth is not the be all and end all. You know, you need to show us how you're actually going to make money.
It is important.
So that I think is changing. It's also a matter of showing, you know, having a company where the upside in the market is easily explainable.
Okay.
You know, so one of the challenges that we had as example, you know, I remember when the Mogul guys were trying to raise their money with stockbrokers, is they'd walk into meetings and they'd sit down and they'd say, oh, it's, you know, this is esports, it's gaming, etc. And you'd have 50-year-old stockbrokers who turn around and say, well, why do I care about video games? That's what pimply teenagers play when they can't get a date on a Saturday night.
They don't understand.
Yeah, exactly. And so you have to have something that ultimately the narrative is easy to translate. So if you have, if you could have the absolutely best piece of software that is enabling the, you know, better development of widgets in the manufacturing industry, but if it's something that goes over the head of 90% of investors, the public markets aren't where you want to be.
Okay. All right. So it has to be clear, understandable to be going into a public market.
Yeah, because most people have to just general information. So
exactly. Well, and the stockbrokers themselves have to be able to understand it.
Yeah, get it.
And they're not going to invest. You know, again, they see 30 floats and potential floats a day.
Yes.
So they're not going to invest hours and hours and hours trying to understand exactly what you do if you can't make it clear.
Same logic around clarity is very important by the sound of this conversation. If you're going to be building a business, it's pretty clear on a lot of things before you step into it. So, and the investors are going to see that there is clarity and research behind this, and it does make sense.
Now, we're out of time, Hamish, so we probably have to get you off in a minute or two.
No
just if anyone wants to reach out to you, how can they reach out? Where can they find any more information or get in touch with you?
Yeah, sure. So the best way, you know, if you want to reach out, I'm on LinkedIn, so that's easy enough. Hamish Hughes on LinkedIn. My email is hamish, Hamish, at fairhavenadvisors.com.au. You can always send me an email there, and just reach out, and I'm always happy to have a chat with people, grab a coffee, once the world goes back to normal.
Yeah. And we'll drop some of those links when we
we'll drop them
and just
for you
talk
as well.
people through what their options are and whether it's something I can be of help with.
And just quickly on that, before you head off, we are talking in the moment of COVID-19 and everyone in lockdown. What's your long-term thinking in terms of investment and what's happening in the world? Will it take a little while for people to pick back up? 6, 12 months? What are you thinking the impact that this could be on investment houses slowing down what they're putting into startups and tech businesses?
I think it is going to slow things down quite significantly. I'm already seeing it.
Okay.
I'm a believer that the economic pain from this is going to be quite a lot bigger than most governments are willing to admit.
Okay.
Certainly for right now, the industry is for early stage stuff has slowed to a crawl.
Okay.
And I think it'll take a while because at the end of the day, when you're an early stage investor, and you're writing, $10, $20, $50,000 checks, most of which are never going to come back.
Yes.
You have to have the ready capital to do that, and there's going to be an awful
Yep.
lot of people who in the flush times were going, I'll have a dabble and I'll set aside a couple of $100K to do that, who
Yes.
after the last 3 months and after the next 12 months are going to say, well, actually I need that $100K for everything else, so
Yes.
I'm going to pull back from that market for a while.
Yeah, they won't have the runway available to them.
Yeah, so I think the end result for the early stage industry is there's going to be less money. Certainly, there's going to be a lot less money for the back of the envelope ideas.
Yes.
That people are going to require more proof point, more work, more bootstrapping. You're going to have to, as an investee, you're going to have to show up with some version of a product rather than I have a concept for a product, give me money and I'll go build it. As an example.
Yep.
Come with some letters of intent with potential clients. Come with some degree of proof of traction, and you're going to see that adjustment in valuations as well. That valuations are going to go down because there's going to be less money being chased by more deals rather than the other way around.
I think I've already seen that from the US markets. What I've seen.
Yeah.
The valuations have come down heaps.
Yeah, and it doesn't help that. SoftBank announced yesterday they're writing off $20 billion out of their fund based on the losses of 3 or 4 of their flagship investments, including WeWork.
Yep. Nice. Very nice. That doesn't help anyone.
They can go and explain to the Saudi royal family where their money's just gone. But
wow.
But that's you're going to see that a lot, and that's the boom and bust cycle of this industry is.
Yep.
When you have the good economic times and cheap money,
Yes.
You get valuation inflation. The one good thing is because you're going to see, I think there's going to be pain for the next 12 months.
Yes.
I think beyond that, you may actually see some acceleration back to the good side, because once things do sort of reach a flattening at the bottom, there's going to be if we thought that there was a lot of cheap money around after 2008.
Yes.
It's going to look like peanuts compared to what there's going to be after 2020. So all that money is going to be looking for a home, be looking for yield, be looking for places to be put.
Yes.
And so I think in 2021, 2022 and beyond, I think there's going to be really good opportunity to raise capital.
So on that note, I would say maybe look at starting to, if you're in the middle of an idea or a concept, maybe putting some bootstrapped hours into that, getting prepped over the next year, 12, 18 months to actually look at that next stage of investment.
That's exactly what I'd say. If at all possible, don't try and be raising money now.
Yes.
But be ready to come out of the gate firing when things come up. I mean, I'm personally doing that with a couple of ideas I have in incubation at the moment.
Okay.
So where I'm sort of doing some work on them on the back burner, and doing whatever I can that doesn't require funds while I'm stuck at home.
Yep, I think that's good advice for everybody. Hamish, really appreciate you coming on to DevReady podcast, sharing your experience and some areas that people can look into just to consider what they need to have ready for funding and what are the options out there. So I really appreciate your time.
Yeah, no problem. And as I say, if any of your listeners want to reach out and and ask any other questions or have a chat, I'm more than happy to to share whatever I've learned over the years.